416% for every ounce of physical silver sitting inside COMEX registered vaults right now. There are more than 4 paper claims saying they own it. That is not a rounding error, that is not a footnote, that is the structural reality of the silver market this week, and if you are holding silver in any form right now, this number matters more than the spot price. Last week I told you to watch the $67 level on silver as the key line between controlled consolidation and something more disorderly. Silver held above that level through the week, closed Friday at $67.95 and held that level even while the US dollar index was sitting at 99.65, which is historically not a great environment for metals. The metal held the line under genuine pressure. I flagged that as the test and it passed. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos, and I have watched what happens when paper markets and physical markets tell two completely different stories at the same time. Every number today comes from publicly available sources, and I will name every one as we go. If this kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. Here is what you are leaving this video knowing. What the 416% leverage ratio actually means, why Shanghai paying a $4.4 premium is draining Western vaults in real time, how to read the 3 lanes framework this week, the one specific thing I am personally watching, and the bull and bear case laid out honestly side by side. Spot silver ZAG or USD closed the weekend at $67.95, up from around $64 3 weeks ago, and if you are holding physical silver or a silver ETF, you felt every dollar of that move. But here is what triggered this video. It is not the price, it is the gap. As of this weekend, the Shanghai metals market was quoting physical delivery silver at $72.35, while New York's it's at $67.95. That is a $4.4 difference, a 6.47% premium for physical silver in the East versus the paper price in the West. That gap is not a curiosity, it is a mechanism actively pulling metal out of Western vaults right now because arbitrageurs are buying silver in New York, shipping it east, and pocketing the difference every single day that spread holds. So the central question this video answers is this. When you have 103 million ounces of physical silver in COMEX registered vaults and 429 million ounces of paper claims sitting on top of it, what happens if a meaningful number of those paper holders decide they want the physical metal? Drop your location in the comments right now and tell me, are you seeing elevated premiums at your local dealer this week, or has it normalized? COMEX registered inventory, according to the CME warehouse reports, it's at approximately 103 million ounces right now, meaning metal that has been certified, assayed, and made available for physical delivery against futures contracts. The paper side is current open interest. Each contract is 5,000 ounces, and when you multiply current open interest against that contract size, you get approximately 429 million ounces of paper silver claims. Divide 429 by 103 and you get 4.16, your 416%. Now I want to be straight about this because this is where a lot of channels get sloppy. This does not mean COMEX is about to implode tomorrow morning, because open interest is not the same as delivery demand. Think of it like counting every person in a football stadium and panicking because the concession stand has limited hot dogs. Most of those ticket holders will never go near the concession stand. They roll positions, close for cash, or never intend to take delivery at all. The reason the ratio matters is that even a small increase in the percentage that do demand delivery, especially against vaults already being drained by the Shanghai premium, changes the math significantly. And right now the CME warehouse report shows registered inventory has been declining, not a one-week data point but a trend. And trends like this in my 15 years watching these markets have a way of becoming self-reinforcing once they reach a certain point. There is a second layer from the CFTC commitment of traders data. This week institutional positioning is showing a rotation out of leveraged ETF exposure and into the eligible category within COMEX vaults. Eligible silver is metal stored in COMEX approved vaults but not yet certified for delivery, and if that eligible metal does not transition into registered, then the 103 million ounce registered number becomes the relevant ceiling faster than the headline open interest figure suggests. The US dollar index at 99.65 is still technically a headwind for silver priced in dollars. A stronger dollar makes dollar-denominated metals more expensive for international buyers, and that mechanical pressure does not disappear just because the physical story looks compelling. If you know someone watching silver this week trying to make sense of these moves, share this video with them right now. The $4.4 gap between SIM Physical and COMEX Spot is not a pricing error. It is a signal from the physical market that demand for real metal in the East is outpacing the supply available at current Western paper prices. Before you run with that, premiums can reflect local taxes, financing costs, and market structure differences that have nothing to do with pure physical scarcity, but a sustained premium of 6.47% over multiple sessions is large enough that it creates real arbitrage incentive, and when arbitrage incentive exists in metals markets, the physical metal moves. The mechanism is straightforward. A trader buys a futures contract in New York, stands for delivery, ships it east, delivers it in Shanghai, and captures the spread minus freight and insurance. The profit only evaporates when the New York price rises to close the gap, the Shanghai price falls, or the supply chain becomes too constrained. To execute efficiently. Think of it like water finding the lowest point in a landscape. The silver is not being pulled by ideology or sentiment. It is being pulled by pure price differential, and every arbitrage trade that completes removes one more ounce from COMEX registered inventory. The demand side feeding this premium comes from two directions: solar panel manufacturing, where the Silver Institute's data shows silver as a non-substitutable component in photovoltaic cells, and AI hardware, specifically connectors, semiconductor packaging, and cooling systems going into data center infrastructure at scale. 4. UK viewers specifically, the North Sea energy transition and the UK government's solar expansion targets feed into this same silver demand pool. British industrial demand for silver is not decoupled from what is happening in Shanghai. Central bank gold buying, as reported by the World Gold Council, continues at a pace that would have seemed extraordinary just a few years ago, and these are not traders checking price charts every morning when a central bank reallocates reserves. That is a multi-year structural decision. The direction of that decision toward gold and away from dollar-denominated assets is documented and publicly visible. The Congressional Budget Office's fiscal projections show a debt trajectory that makes the dollar's long-term purchasing power mathematically uncomfortable to look at. Honestly, I am not saying the dollar collapses next Tuesday, but the math is getting harder to ignore. De-dollarization is a decade-long structural process, not a Tuesday event, but the direction of travel is visible and documented. The paper lane, the CFTC commitment of traders' data this week, shows the rotation out of leveraged DTF positions and into the eligible physical category, which is not what panicked retail money does. That is what patient institutional money does when positioning ahead of a potential supply squeeze. The 416% paper to physical ratio against 103 million registered ounces is the specific number that matters here. And if the Monday open sees Asian buyers front running the Shanghai premium, we could see COMEX shorts under genuine pressure to cover. The physical lane, the $4.4 Shanghai premium, and the directional decline in COMEX registered inventory, with physical premiums at retail dealers elevated in both the US and UK, consistent with the wholesale picture. The macro lane, the DXY at 99.65, the US 10-year yield, and the central bank buying trend. The dollar is weak by recent historical standards, which is structurally supportive for metals priced in dollars. In 15 years watching currency and commodity markets, the times I have seen all three lanes align in the same direction even briefly have historically been some of the most significant moments in these markets. When the paper lane shows institutional rotation toward physical exposure, the physical lane shows active vault drain. And the macro lane shows dollar weakness. The historical pattern has been that the gap between paper and physical does not stay wide indefinitely. The market either resolves it by moving the paper price toward physical reality, or by physical supply becoming constrained enough that delivery mechanics become the story. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week: the US 10-year Treasury yield against the 4.5% level. If the 10-year breaks above 4.5%, historical correlation data shows that a liquidity-driven risk-off move becomes significantly more probable, and silver could see a technically driven pullback toward the $65 support level, not because the structural case changes, but because leveraged paper positions get unwound fast when yields spike and margin calls hit. If the 10-year holds below 4.5% and Asian buyers come in at the Monday open front running that Shanghai premium, the setup for a gap up and short covering squeeze is genuine. This is my one call for the week. John, FX Insider. On record, I will be back next video to tell you exactly what happened. No edits, no excuses. For the optimistic picture, Asian buyers come in strong at the Monday open front running the $4.4 Shanghai premium, forcing COMEX short holders to cover. The 10-year yield stays below 4.5%, and physical withdrawal from COMEX vaults continues at its current pace or accelerates. In that scenario, the paper price moves toward physical reality and silver breaks higher from current levels. For the cautious picture, the 10-year yield cracks above 4.5%, triggering a broad risk-off move. Leveraged silver longs get margin called and sell regardless of their view on fundamentals. The Shanghai premium narrows as Chinese buyers step back, and silver finds support around $65 but gives back a meaningful chunk of the recent move. Both are genuinely possible right now, not as a hedge, but because it is actually true. Watch the 10-year yield Monday morning. Watch whether Asian markets open with a gap. Watch the COMEX registered inventory number. When the CME updates their warehouse report, the market will tell you which lane it is taking. Before we close, everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here is a recommendation to buy, sell, or hold any asset, and past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. That disclaimer is not a formality, it matters. If you got value from this today, the like button takes 1 second and genuinely helps this channel reach people navigating these markets without all the noise. I want 2 honest answers, not just a thumbs up. First, are you currently holding physical silver, paper silver, or both, and has the 416% leverage ratio changed how? You are thinking about that position today? Second, the $4.4 Shanghai premium, do you think the Western paper price moves up to close that gap, or does the Shanghai premium come down? Subscribe next week. We are going into the CFTC Commitment of Traders report in detail, showing you exactly how to read managed money positioning as a contrarian signal, a genuinely useful skill most retail investors have never been taught. And if someone in your life is watching their stack right now feeling confused about what is happening, share this with them. This is Currency Insider. Know the market, protect your currency.